Welcome to the On the Tape podcast. I'm your host, Danny Moses, and today I have the pleasure of welcoming my friend Larry McDonald to the pod. Larry, welcome to On the Tape.
Danny, thanks for having me. I really appreciate it.
So your pen name is Lawrence. But before we get to your writing prowess, I want to go to your background that started, I want to say, on the streets of Boston and Cape Cod, but it is fascinating kind of how you were brought up and where you are now. So let's start with kind of young Larry and work our way up.
Well, yeah, I mean, it was during the S&L crisis. I was coming out of college, and it was very difficult to find a job. And one of the parts of my first book, we talk about trying to get a job on Wall Street and really getting in there and trying to discover where you want to be and what part of finance you want to get into. And what I try to do is just, at one point, it was after all those rejections, rejection after rejection after rejection. There's a scene in our first book, The Colossal Failure of Common Sense. It's a New York Times bestseller. It's a top 20 all time at the CFA Institute. So it's one of the best books in finance of all time. And I dressed up as a pizza delivery guy to try to get into the Merrill Lynch building in Philadelphia. And I snuck my way in there and, just finally, got into the retail side of the business, built up a nice business, not too fancy, but then, we started to see the .com move coming at us, and I was fortunate enough to create a website called convertbond.com with my good friend Steve Seefeld, and we were able to sell that to Morgan Stanley in October of '99, which was really we were very fortunate. If it was a couple months later, we probably wouldn't have got much for the. But we really hit it big there financially, and then I was able to we were able to sell the property or convertbond.com to Morgan Stanley. And then I made my way from the retail side of the business to the institutional side. And that was right around 2000, 2001. And then got my big break in 2003, 4. Bart McDade, Mike Gelban, Larry McCarthy brought me into Lehman Brothers. And I really have so much respect for Mike Gelban, Bart McDade, Larry, and Alex Kirk, that whole team. There's a really wonderful group of revolutionaries within Lehman that were trying to stop the madness. And, it ended up being one of the largest bank failures of all time, but you kind of had a front row seat to that pretty big, domino that fell in 2008.
So I was going to get to the bestsellers, and I'm going to get to the colossal failure of common sense, or a colossal failure of common sense, I should say. So let's talk about Lehman for a minute. Since you and I obviously were both trading the markets at the time, and you're running distressed desk at Lehman during this time period. I think that's when we first met, I think, over Bloomberg, and we got to know you a little bit better because I figured Larry has to see what's happening here. And what's going on inside of Lehman was, I felt like the majority of Lehman employees either didn't want to believe it or were being sold a bill of goods, or we're going to be fine. Because to your point, when you're in Lehman, you know how smart everyone is around you. It's like there's no way that this place is going under. So talk to me about the realization of when you knew you were in real trouble. And I can give you our vantage point at that same time, but we were certainly trading the markets together.
Yeah. To me, my favorite line is, the Lehman was never rotten at the core. That's where all the beauty was. She was rotten at the head. And it was like early 2007, we noticed, maybe late 2006, we noticed that the management team was spending a lot of time on philanthropy, a lot of time on some nice things, art collections and things like that. But the core part of the business, the people on the credit side of the business were really kind of seeing this subprime disaster develop. And we on our team, we were short New Century. I think you guys had some of the same trades we had on. You guys did it, I think, the smart way. We were doing it through what we call public options. And we were shorting subprime players like MTG and Radian through puts. And so we were really short. And the problem is, for every dollar we were making on our floor, they were losing about $7 or $8 upstairs. And so that was the first time. And then I'll never forget, we're at a dinner in early 2007, where we started to hear how much exposure the bank had to what we call commercial real estate, and all these types of derivatives of commercial real estate. And at one point, one of the guys at the dinner said, we're really just a massive leveraged REIT or real estate investment trust with an investment bank on the side. And that's what I really said, oh, wow. What I started to do is I started to, I had a great relationship with Patrick Robinson, who was up on Cape Cod. And I made my way up there and I tried to, pitch him on why we should write a book about this potential, big bankruptcy.
Well, let's not just skip over that. I want to go back into the trenches again. Obviously, we had been looking at the 10Qs and listening to the calls, and we found these VIEs, right? These entities that were off balance sheet, which Lehman had a percentage of. And like Lehman, Deutsche Bank, they all had these external mortgage originators that they ended up either trying to buy in or they were doing business with. One of the things that we saw was when the big banks started to cut the warehouse lines off to the mortgage originators, which were feeding kind of the machine, we knew there was a backup. Lehman, just in my mind, I just want to clarify, you don't have to talk about it if you don't want to, but was denying, but it became pretty obvious. So I guess my question to you is, you called up this other writer. By the way, I want to note that he did write a book about the USS Seawolf, which was the name of our hedge fund. Vinny Porter and I started ourselves. So we obviously have some type of connection there. But anyway, we don't have to go down that route. But there was something else there, Larry, because you were making money in your book, and here you find out that there's this shadow over you. So can you go a little bit more in detail? I mean, I know you write about it, but maybe you can talk about it a little bit more.
Yeah, it was just there was the credit side of the business. And so I was on a desk with high yield traders, investment grade bond traders. And what I find is like the credit side of the business, they tend to be, way in front of the equity people a lot of times. But then there's the real estate side. And we've always felt, that they had a much better connection to the board. The board was very, very, a lot of older people, not really good financial people, but that part of the business, the mortgages and the commercial real estate, were such a big moneymaker that the CEO and the management team just, fell in love with these people, and and over the years, they became more and more detached, and they just never really looked under the hood. I don't think the management team really fully understood the risks of the derivatives on that side of the business.
Yeah, and I think when they announced, I can't remember exactly when it was, I think it was 6 months prior to the collapse, was the breaking up of into a good bank and a bad bank, I think is what happened at Lehman Brothers, if I'm not mistaken. When you heard that, you had to think to yourself, okay, how are we going to offshoot this thing, recap the new whatever? That to me, when the puzzle started to kind of come undone, in my opinion.
And then David Einhorn, who over the years I've developed a great friendship with him. But when Einhorn really started to go after Aaron Callan and the Irish, Einhorn did a Greenlight Capital is the firm, but David did a courageous Irish zone speech. I think it was in this early spring, maybe winter of 2008, where he kind of outed them. And then you're right. Then they did the good bank, bad bank. And whenever you see that, a lot of times, there are some instances where it works, but a lot of times it's a company that's really heading down, where they're trying to put the good assets on one side of the bad assets on another side, and most times it doesn't work.
It's funny, a quick Einhorn story, and he is brilliant, and I've gotten to know him over the years and played poker against him a couple of times, but thank God those were charity events and not for real money. But anyway, he took a shot on the long side at New Century in 2005. I'll never forget. And I think through that process, and I think he realized after a short period of time, he wanted to break the thing up. He thought the sum of the parts was great. They had to split it up, and it crushed me, because I left Friedman Billings at that point, and I was basically out there saying, this New Century is going to fall apart. And he did this. And just goes to show you, just in general, we're going to get into the markets and stocks here, that even the brilliant minds that look at something, or people rush to judgment, either on the long or the short side, you take a step back. And I think he realized it soon after, but there was a time for it in 2005. And I think he took that knowledge and applied it to the rest of things going forward. I think once he pulled the hood, I think he realized that. So before we get to your new book, which, by the way, came out last year and actually portended many of the things that we're dealing with right now, we're going to get into your real-time thoughts on the market here, and then we'll get into the book. But front and center right now is the U.S. debt, deficit, tax bill, tariff policy and all these things. And the market seems to absorb it amazingly well, right? But there's stuff going on underneath the surface in the markets and commodities and so forth. So give me your thoughts, first of all, just kind of on how unsustainable the debt levels are. And you talk about the Treasury General Account, the TGA, so people, we don't want to get too wonky, how that's all factoring in now to your thought process.
Yeah, so we'd like to look at the birth of a narrative and measure that life cycle. And if you think of like Ray Dalio has been out there on the bearish side of bonds for a while. Paul Tudor Jones has been out there, Gunlack last week. So it's a very well-known risk that this is happening in the third, fourth quarter of this year. Remember, Janet Yellen in 2023, when they hit the debt ceiling, they couldn't issue any more debt. And then what happens is you can't issue any more debt. And then at some point, they raise the debt ceiling, and then there's a huge, huge, colossal catch up. And that is what was happening in from 2003 to 2004. And treasuries, once they raised the debt ceiling, treasury yields backed up almost 100 basis points. And that created a real big problem for the bond market. And so everyone knows this now. So to me, the life of the current narrative is very, very well known. What's not so well known is some of the tricks up Basant's sleeve around what I call financial repression. And all that means is the only way out of that $37 trillion debt hole is when you massage interest rates below the rate of inflation. And the way you do that is through creative techniques. And what you can do is Basant's new bag of tricks, I think, is now in the marketplace, is now coming out. And more people that, like, we basically have a business that faces institutional investors. And most of the institutional investors that we talk to in the last couple of weeks are really picking up on our Treasury Secretary Basant and his bag of tricks. And all they come down to is what I call, is, like I said, financial repression. And that's to say the supplemental leverage ratio, just forcing the banks to own more treasuries. And then really through regulation and threats, like think of what Ted Cruz did last week. Ted Cruz, he basically put a gun on the table to the banks. Interest on excess reserves. The banks basically get $1 trillion a year on interest on excess reserves. Ted Cruz is almost like Trump's pit bull on the side, right? So Cruz is out there saying, "Oh, we want to float a bill on the Hill where we eliminate the interest on excess reserves," and that would really crush the banks. And so I think the reason he's doing that is he wants any of the banks, we need their participation on this SLR. So we need the banks to buy the treasuries. And so everyone knows this disaster is out there in September because we're going to raise the debt ceiling. We calculate a $1.6 trillion issuance between August and say November. And that's 600 billion more than last year. And so that's the problem, is that that's out there, but Basant's going to use the banks to basically force them to buy more treasuries with that gun on the table from Ted Cruz. We're going to do a deal with Japan. And guess what? Part of that trade deal is going to be them buying longer dated zeros and buying bonds. So Basant has this war chest of tricks. There's this new act on the Hill around stable coins, and they're going to try to use that stable coin bid on T-bills and the shorter dated treasuries. And they're going to basically borrow the treasury. It's going to borrow and sell T-bills, borrow there, and buy longer dated bonds. So there's all these things that are out there to kind of offset this big blob problem, what we call the Liz Truss moment that's out there in the third, fourth quarter of this year.
So I want for people out there, I've talked about the SLR before, and for people that don't know what it is, it's effectively the amount of capital the banks have to hold U.S. treasuries. And it really shouldn't be a lot. I mean, that thing's been miscalculated, I think, for a long time. This is not a new subject that has been brought up. It's been talked about, obviously, for a few years. So I think there is capital relief coming. Now, whether the banks go buy more treasuries with that capital type of relief is not that certain, but I hear what you're saying. And your point you make is that as long as Basant can talk a good game, that can go a long way. People's confidence they can own treasuries because, quote, we're going to be there. But talk about the Treasury General Account more, because it's being dwindled, obviously. It's still substantial. But to your point, this debt ceiling, which people out there, we're currently, running north of $36 trillion in debt. The House bill is asking for $4 trillion. The Senate's asking now for an additional $5 trillion. Let's just say it's $5 trillion. We're going to go above $40 trillion. To your point is it's a deep breath moment, but here comes the flood. So what's left in the TGA and when does that run out? In August, September? Is that what you're referring to?
Yeah, so this is where it gets really interesting for people watching us right now, because if they don't pass the what we call the reconciliation bill on time, and so that's coming together right now. There's a House bill and the Senate bill. The Senate bill's coming back to the House. They have to reconcile the House bill and the Senate bill and bring them together. If the conservatives don't agree on the Senate bill, because, and by the way, there's some pretty nasty, violent spending in there. Trump and Musk told the world 2 or 3 months ago they wanted to balance the budget. That looks like a complete, whether forget about your politics, that looks just like a complete fantasy. So the conservatives on the Hill are not happy. And when they try to merge these bills, if there's a delay, then what happens is the Treasury General account, which is just it's their cash, it's their checking account. If that gets drawn down too much, and let's just say it maxes out around 700-800 billion, it can get down below 100 billion, and say it gets down to 50, then the refill of that, and that's where you have to sell the treasuries to refill it. And that's why once you're at the debt ceiling, you can't issue any new debt. January, February, March, April, May, June, July. There's been no new net issuance. So the Treasury's checking accounts being drawn down by spending. And why does that matter for people watching us? Because the violence of that refill depends on how big it is, and that refill, the violence of it, and that means just selling bills and selling notes and bonds. That's what could create a colossal dislocation of the Treasury market, especially if oil stays up here because of the tensions in the Middle East. And that's where you have a real event where the Fed has to step in and really help the banks and defend and basically support the Treasury market. That weakens the dollar, and that creates a big colossal move into what we call hard assets and commodities.
All right. So before we get into that, I just want to get your thoughts. So U.S. bond market, you think yields move higher, a combination of inflation, issuance that we know is coming, right? So what is the level of the 10-year yield where the market really has this? Is it 5%? I mean, that seems to be kind of the token number that people are using. It's not an absolute number, but where do you think that people really start to have fear in the equity markets and what that means to
Yes.
price?
So 5% on tens, Bank America at that point was down 55% off the highs, 50% off the highs. So the last time the 10-year Treasury was near 5%, Bank America was in a bad spot. What I'm noticing, Danny, is that on the commercial real estate side, a lot of these guys have been, they have these loans that they've been rolling over, and they've been rolling them into short term. And so what I'm noticing is the commercial real estate side is having some stress now because of the front end. So there's that. And the bottom line is this is why Trump's making so much noise. He knows the commercial real estate and the banks, they desperately need that front end lower. And so, yeah, I think five's the point, but it's getting, because we're higher for longer for so long, the victims in commercial real estate, private credit, on the consumer side are piling up. And we really need rate cuts pretty fast. And the problem is oil and everything that we're seeing in Washington's preventing that traditional relief from the rate cuts.
Correct. And we have Powell. We're sitting on the eve of obviously Powell's meeting. The Fed's obviously not going to be cutting or raising rates tomorrow. We will get a dot plot. So we'll get the quarterly economic projection, which could be quite interesting. So what can Powell do anyway right now? And I want to go back to Besson and Powell potentially communicating about some type of, I'm going to say quantitative easing or QE5, but we've already been told, and we might get more of this tomorrow, that the runoff in mortgage-backed securities in excess of $35 billion, and we're now running off $5 billion token amount U.S. Treasury, so really zero, could be reinvested, into U.S. Treasury market. So that's a form of kind of QE to a degree. So what do you think we hear tomorrow, and what do you think about that?
What the Fed's going to do is they're going to end QT, quantitative tightening, that they have to do, and the market's forcing them into that. And then and by doing that, like you said, they can automatically start using some of the mortgage-backed securities and buy treasuries. And so they desperately need to get to QE, and for a whole bunch of reasons, because they know what percents, like Powell is on percent side. He knows what percent's up to, what up against, with this massive explosion in that fourth quarter of issuance. And so the Fed's going to start to shift gears toward that more dovish. That's why the dollar's been so weak, because the dollar's smelling out what we call financial repression. And all that means is when you just use whatever levers you can, you force the Japanese to buy more treasuries, you force the banks to buy more treasuries, you bring the Fed in, and you're just trying to massage interest rates below or at the rate of inflation. And that's creating this big movie. That's why you look at silver outperforming the NASDAQ, and then silver's outperforming the S&P over the last 1 year, 3 year, I think out to 4 or 5 years. It's the same thing with gold, same thing with platinum. So we're starting to see that trade broaden out as people want to own other, instruments that will protect them against that kind of financial repression.
So I want to get into some of that, but I think the lead into that is obviously your new book, How to Listen When Markets Speak, and you talk about the risks, the myths, and the investment opportunities with that. Well, there it is. There you go. How nice that you had one handy. Who would have thought you'd have one ready to show there? You can find that on Amazon. You can find that on the New York Times bestseller list. All right. But Larry, within that, I think it's really interesting. You bring up repression in the financial markets, and you and I both traded through the great financial crisis, right? And that's the bookends of the two, because we've been repressing kind of real markets, right? What is the real level of assets? What should they be if the government's, quote, not involved? And here you are saying, and I agree with you, we're going to keep going. We're going to QE5 at some point because there's no way out. So within that, and within your new book, let's talk about the risks, the myths, and the investment opportunities. You just went into kind of silver, and I was going to ask you about gold in particular and platinum. Let's start kind of with, I want to say, hard assets, companies that own hard assets, or things that you consider hard assets, because I believe that that's part of your theory of in the investment opportunity bucket within your new book.
Right. And if you look at Einhorn, or if you look at Buffett, if you look at some of the greats now, I mean, Buffett's clearly taking down his technology exposure and adding to energy through Oxy and others. Einhorn's doing the same thing with Weatherford, Nicoll, other energy names. And at the end of the day, the Lehman Brothers fiscal and monetary response in Washington was about $4 trillion. Now, the fiscal and monetary response to COVID, the regional bank crisis of 2023, and Team Biden, they wanted to juice fiscal into the election. Those things, if you add them up, is $16 trillion. And so that's what gets you into this. You want to be in what we call a multipolar world, 1968 to 81 portfolio. A multipolar world, all that means is if interest costs are more than your defense budget, then at some point you're somewhat limited. And the United States just can't afford to be the world's global policeman. And so we notice that we're seeing more global conflicts, or obviously Iran, the Middle East, Gaza, obviously Ukraine. In all those environments, wars are so inflationary. Think of the Ukraine rebuild, Danny. Think of the Gaza rebuild. Think of the Iran rebuild, right? And then you think of the Los Angeles rebuild with the fires, right? Wars are very inflationary. Neil Ferguson, I sat down with him in my book, How to Listen When Markets Speak. Neil Ferguson's like, he went through the math. We go through the math in the book of why wars are so inflationary. So if we're on a new trajectory of, say, higher inflation, higher interest rates through this, like all these bonds for sale to support this massive debt load, you really need to be in that 1968 to 81 portfolio, which is more driven toward hard assets, companies that own hard assets, whereas the previous deflationary era portfolio was that just really paper certificates, stocks and bonds, right? That's all you need. In a deflationary world, that's all you need to own. But in an inflationary world, think of that DCF model, discounted cash flow, which we can get into. That's where you need to own companies that own natural gas or something about hard assets.
Larry, within the energy sector, I've been talking about this for the last several quarters, and so have Porter and Vinny and some other smart people that I know that you talk to, and specifically energy as a weighting in the S&P 500 got down to 3%. I'm sure it's a little bit higher at this moment because of this rally, and historically it's been 7%. That's kind of been the average over time. And you know how these large portfolio managers work. They underweight sectors, they overweight sectors, and within those sectors, they overweight and underweight certain stocks. Well, unfortunately, it took another Mideast crisis to kind of put it back on the radar screen and oil to move higher. It feels like this time with oil moving higher, though, you're getting kind of a re-underwriting of these energy names, to your point in general, that even if oil retreats and hopefully things calm down, oil retreats back into the high 60s, it feels like new eyes or fresh eyes are coming into this space. So within energy, I know people maybe don't consider that hard asset. I do, just because it's
Oh yeah.
you own it. So talk to me about the energy names specifically that you're looking at, and then I want to go into the next level of energy, which is nuclear, uranium, and AI, and so forth.
Well, the biggest stat, I think the most bullish stat for the oil names or the oil sector or the energy sector is there's 27 trillion in the NASDAQ 100. That's backed up on the highs. So 27 trillion. Um, and there's only a little bit more than 2 trillion in the energy space. So 27 versus 2. 10 years ago today, these were like relatively almost the same size in 2014, 15. So you've gone from roughly the same size 10 years ago, maybe information technology was a little bit bigger, but you've gone from that to 27 trillion versus say 2.5 trillion. So that means that if inflation normalizes at a higher trajectory and we're in this multipolar world, if there's a great rotation, which we're starting to see, that's going to be very supportive of energy stocks. Energy stocks are trading. Now think of like the valuation versus the long-term trajectory. They're trading at 45% of the say the 10-year mean. That's on the PE basis. So that's really cheap. Whereas tech stocks are trading at literally almost 100% of their they're 100%. They're way above. They're 28 times earnings, right? 28 times earnings for information technology, which is right near the all-time 10-year high, or what we call the high 98th, 99th percentile of that 10-year period. So it's the perfect time to rotate out of information technology and into energy. And if we look at Weatherford, Einhorn, we really respect Greenlight and David. And if you just look at like Weatherford, Apache, the valuations of Apache at one point in the last month and a half was trading at like 1 times EBITDA. Like, and remember, once they changed the name from Apache to APA, everything went downhill by that. But
Right.
we'll get to that.
Right.
But then at Weatherford, the service sector has been really cheap. Weatherford's trading, I think, three times EBITDA, and so you've got real good valuation, and you also have a sector that has delevered much. So remember, you had the 2016 commodity crash, and the oil names had a big, very tough time in that period. So and they had a big tough time in 2020, right? So you've had 2 crashes in the energy space that they've really dramatically delevered. So you have much cleaner balance sheets. Your risk reward is so much better than in past cycles.
You bring up actually a great point on the macro front, which is the irony is that in order to get these IT and tech stocks where they need to be, it's based upon power generation coming and basically powering all this stuff, right? So within that, nat gas, obviously for various utilities is certainly important. And now we're moving into the kind of the next leg of energy demand, which could come in the form of nuclear, right? And which again comes in the form of uranium. So can we talk to that a little bit here? Because I think that also brings it kind of all together, right?
Well, 10 years from now, they're going to look back at Jensen, the NVIDIA CEO, the great pump master. I mean, there's no great pump. He's the greatest pump master of all times. He's a smart guy, but he's a slick salesman. He's signing braziers. I mean, come on. I mean, this is a pump master. And he's just now, for the first time in his speeches, is really getting into the energy side. But it's been like 2 years of pump, pump, pump. If all you did was kind of sell NVIDIA stock or sell the SMH, remember the SMH is down 3% over the last, I guess it's year and a half or so since March. I guess a year and a quarter, down 3% with the what I call the NUKZ, which is an ETF we recommended to clients last year. It's 60% outperformance relative to the semiconductors. 60%. So the SOX semiconductors down 3% since last March of last year. And so you're seeing like a very cheap part of the markets, it's under owned. And then you're seeing the semiconductors, which everyone's trying to be part of that trade. And if you believe Jensen, if you believe Nvidia, if you believe the sales pitch, if you believe he's half right, then we have a colossal energy crisis coming at us in natural gas, in copper, just the amount of copper you're going to need for the power grid to support. We have and literally a power grid that's 50 years old in some place, 30 years old in others. All the data centers, robotics, 2 million robots that's just one of the low estimates out there. 2 million robots would eat up about almost 3 to 4 weeks, almost for a month of global copper production. So all these clowns on Wall Street, these technology people, this is one of the greatest clown shows because they're all falling all over themselves to come up with these estimates and price targets for all these different tech stocks and all these different semiconductor companies. And there's no way you can reach that growth path. There's no way you can reach it without literally the copper, uranium, and a lot of these different types of equities being up like 400, 500, 600% to support that kind of growth that you see in AI.
Well, I think prior to Jensen and these, overselling or whatever it might be, or hyping, Elon Musk kind of set the stage for all of this, right? In terms of, dream the dream until you can't dream it anymore, and all that stuff. So there's almost precedent setting was Musk before Jensen. I mean, so if Musk didn't come first, Jensen seems like a logical genius relative to Musk in terms of overpromising, under-delivering. But you make a great point, in terms of, again, on the macro of it, if you truly want to buy these stocks, the tech stocks at these levels, then the only reason you would buy those is if you actually believe that the demand's going to be there. And if the demand's going to be there, then we are way underexposed to energy. And there's going to be, like you said, a shortage of things. So that makes a ton of sense here.
You just have to look all across, like platinum in the green hydrogen space. The whole energy revolution is coming at us through a whole new ecosystem of energy that's going to be needed. Battery technology. There's just a whole portfolio of companies that are going to be much better, much better performers than, say, Nvidia, which is already above $3.4 trillion in value.
Something that was born out of the financial crisis and regulation of banks, and then easy money from there, is private credit. Private equity's done an amazing job of gathering those assets and deploying those things into loans. And eventually, we're sitting on multi-trillion dollars now, Larry. So here we're going to have another issue, which we will have eventually when you have a normal economic cycle. The question is, do we even know how big it is? Again, people are at ease because it's, quote, not systemic, but it doesn't mean that it can't impact every aspect. And by the way, you and I both know the banks are lending into it, so they're not immune. They're just not as involved as they were. Vinny, I asked Vinny this question. He's like, they're just going to bail them out. They'll just bail out private credit. And you know what? He's probably right. There'll be a towel for something that'll come. What are your thoughts on the role of private credit and where this thing is headed potentially?
Well, first, a lot of the smart money financial, hedge funds in the chat. So we host that buy side conversation with institutional investors every day. And what we do at the Bear Trap Report is we share kind of that intelligence gathering with, our family offices around the world, our retail investors. And what we're noticing is that the amount of people skeptical on private credit is growing and growing and growing. And it's much more it's much more high conviction. And I noticed that one of the stories we're hearing the last week is that John Cortese was one of the best traders I've ever met at Lehman Brothers, one of the best. And he's now at Apollo, and he's on the private credit. I mean, he basically runs the credit business. And what we hear, and this has been out there, is that Cortese and that team have proposed creating a secondary market trading desk on private credit. And that would be extremely disruptive to the private credit business because you're supposed to be private credit, not creating secondary markets, right? And so if this were to happen, and remember, Apollo is dealing from strength. They're much more high quality, like they're dealing with the more high quality credits, whereas the rest of private credit is broadened out to more tertiary, more ugly credits. And I think the amount of high conviction disgust for private credit that we're hearing across, the different clients that we speak to, and the conviction that something could really blow here, especially if oil were to keep rates up and we don't get rate cuts. you could see a pretty nasty default cycle in private credit. And the fact that Apollo is thinking about creating a secondary market for these securities speaks to how much potential damage there is, right? Because people want liquidity. And to me, it's a watershed moment. It's like the moment, you remember the moment when Temasek, Danny, which was back when we were at Lehman and you were in your seat, and what you laid out in the Big Short is the moment when Temasek started to exit they start to buy the Merrill Lynch portfolio on the CDO side. So Merrill Lynch started to basically was forced to liquidate these illiquid assets. And when you see that big moment like that, to me, that's a signal that something's turning, because why would one firm kind of go? We hear the Ares of the world and the KKRs. If this happens, they're not going to be very happy with Apollo and that group. So we don't know for sure if it's going to happen, but if it does happen, that would be something that would be, I think, a watershed signal post for private credit.
Yeah, where were the signs, right? Another sign is obviously retail investors all of a sudden getting access, hallelujah, to private credit. Congratulations, people. You're about to pay, 3 to 4% fees that'll be embedded somewhere. And lo and behold, BlackRock is just finalized a deal to buy Preqin. And if I'm not mistaken, that is basically sets prices for private loans in the marketplace. So, quote, third-party marks that now BlackRock now owns. So I thought that was another interesting feature. But talk about, retail investors getting access to a product. It tells me that institutional is full at this point.
This is so ugly, because from we hosted an ideas dinner last week in New York, and we had some, what I try to do is mix in the crowd where we had some really large buy side, like institutional investors, but I brought in a couple of big wealth guys, like really big wealth managers. They said the pressure is on near disgusting level from senior management. They are pushing private credit into their brokers, right? And to me, it's like it's really smart money. I don't call it dumb money. I would be rude, but you're just less sophisticated investors that are being kind of heavily incentivized through all kinds of commissions and all kinds of transactions. So you've got the retail side is buying these products probably at like 90 cents on the dollar, when the real clearing price is probably more like 60 to 70 cents on the dollar.
So you talked about in the new book, you talk about risks and investment opportunities, which we've just gone over. I guess the myths that you're referring to, maybe what myths, maybe it's believing Jensen Huang's numbers in the longer term, believing this secular trade will go on forever. What are some of the myths that you're kind of pointing out there in the book?
Big one's passive investing. So in other words, there's a perception that passive investing is safe. And if you talk to really, like, I think Jack Bogle meant well, but a lot of institutional players that we speak to, and this has been growing and growing and growing, the awareness of this is growing. So when you go from 51 to 52 to 53, 54% passive versus active, what happens is, think of like a stock like Walmart or Costco. And let's just say Costco is buying back shares, right? They're doing a buyback. And because passive has gone from 51, 52, 53, say it's almost 56% versus active, that means all these Costco shares are owned by BlackRock, Vanguard, and State Street, and they're not for sale. They're not for sale because they're in passive funds. And then as the market goes up, the passive funds have to buy more, right? So there's 401k money that comes in every month, and then the company's doing a buyback. So your actual liquidity, your actual amount of shares that are for sale, and don't forget, as the stock market goes up, the active funds have to chase the passive, because they have to at least keep pace with the S&P 500. So your real amount of shares that are actually for sale is tiny, and that's what creates, look, the stocks like Walmart are trading at 40 times earnings, and the valuations on Walmart and Costco are just classic passive idiocy. That's just literally a bunch of people that are drinking the Kool-Aid, and they don't understand this is a massive myth. index funds are not safe once passive gets near 60% versus active. And all that means is everyone's long the index, and there are no real players buying and selling stocks anymore. It's just a bunch of wealth that's in very concentrated positions, and there's no, it's not a two-sided market anymore.
So, and it creates a chase by the active money managers, to your point, because their benchmarks and how they get paid are to outperform those passive funds you're talking about. So, we mentioned before about overweighting tech stocks. They have to own Nvidia if you're at Fidelity, whatever, because if you don't and it goes up, you're never going to catch it because it's becoming a
Right.
bit. So
Right.
it's self-fulfilling. But within that layer, and I've been talking about that for a long time, as many people have, like yourself. Instead of fighting it, just play the game, and the game becomes you get an opportunity to own energy stocks because all of a sudden it's 3% of the S&P. You get an opportunity that, analysts that don't bother covering any of these small and mid-cap names. There's a ton of alpha, right, down in the small and mid-cap land if you're patient. And you find it, yes, sometimes it needs a catalyst because no one cares about it or pays attention, but eventually cards speak, so to speak. And so what we've seen is staircase up, elevator down in these markets because of the passive. When flows go one way, it's an elephant through a mouse hole.
Right.
So like you, I like to take the opportunity, take advantage of moments like that, understand the game we're dealing with. Instead of fighting it, just play it. So I'm sure you see on days where we get those large drawdowns, right? Oh, biggest drawdown since fall of last year. Biggest draw. That's a huge opportunity to kind of think on the long side more than as a short side. Would you agree?
Yes, and especially if you think of the index arb funds. So everybody looks back at the volatility this year was driven by trade, but people forget there was a big index arb blow up, and all that means is there are funds that know about this. It's obvious to them, right? These are hedge funds, so they know the companies have to buy back stock. They know the active is chasing passive, and so what they were doing is they were buying. They were basically pushing this small group of stocks that lead the S&P 500, and they were short the index, and they were just juicing that. That's why we had those Mag 7, and maybe it's like 20 stocks that are dramatically outperforming the index, because the index arb guys, they know there's a lot of buybacks. They know there's no shares for sale. And if passive controls all the flows and then active's chasing passive, there are no real shares for sale. So if a cabal of hedge funds pushes this, it exponentially increases the trade even more. And what happened in the February to March, that period, we had a couple of index arb funds blow up, and that, to your point, it's exactly what happened. Is that the trade got too crowded, and a lot of times these are in what we call multi-strat funds, where if one big fund goes down, then you get a ripple effect where 5 or 6 or 7, or maybe I heard upwards of 15 of them all had to unwind the trade. And so it was, and they were all long these 15 stocks, right? And so that created that first leg down. And that was kind of triggered by the whole AI issue with pressure coming out of China. And I think that triggered it. But yes, I think that was just, to me, that's a tremor before the quake. Like that's one of the first warning signs that we're seeing where passive, that's a case where, to your right, like the smart money knows, the smart money knows that this passive thing's overdone. But to me, that index arb blow up in February, March was the first kind of like, okay, we have, Houston, we have a problem.
Larry, I mean, you talk with passion, you write with passion. People should follow you. They should buy your books, but they should also follow you. So Bear Traps Report, you can find where?
Well, the Bear Traps Report, on our website, on Twitter, we're at ConvertBond. We're out there with a lot of good blogs and podcasts, and, we're regulars on CNBC and Fox, but yeah, the beartrapsreport.com is a great place to find us. Find us on X at ConvertBond.
Perfect. Well, Larry, I know you're very busy, and I can't thank you enough for your time. I know you're on the road. I got to see you in person last week. I hope I get to see you in person again soon. I hope you'll come back on the tape because with your experience and your intelligence, I think you're extremely valuable to the investment world. And go pick up How to Listen When Markets Speak at your closest Amazon store where you can. And so, Larry, thanks so much for coming on the tape.
And remember, for people watching us, for young people, it's all about asking. It's about finding great mentors. I've just really worked hard at asking great mentors like you and other people that I can trust and make me smarter. And this book, How to Listen Market Speak, is just about like a Tom Brady type attitude about asking, and building that great repertoire of mentors that can help make you, smarter and build a career.
That's great. I actually look forward to the next one. So we had one in 2009. We got one in 2024. I hope we're both around for the next one in 2039, but I'm sure we
Yeah,
might
yeah.
do that. Larry, thanks for coming on the tape.
Thanks, Danny.